Okay, that's fine. Just join in when you get there. All right, bye.
Check, check, check.
John, we got you.
Awesome. All right, it says I still can't start my video though.
Hang on. Try now, John. There we go. Good afternoon. Welcome to our latest webinar from the Glenn Jones Group and Coldwell Banker Access Realty. Today we are discussing game of loans, kind of an interesting topic like the TV show. There's a lot of products and different topics to discuss. So we're going to get into it today. Just want to first off by saying if you have a question at the bottom of the screen, there's a box that says Q&A. Our group partner, Christine Estridge, will be answering those questions there and sending some over to us if we need to answer someone on the telecast. We're fortunate today to have with us some great knowledgeable folks I want to introduce to you now. First off, we have Adam Hart, who is Vice President of Bank South in the Mortgage Department, one of our lending partners here at the Glenn Jones Group and Coldwell Banker Access Realty. We also have a mortgage broker, Austin Amick. From a realtor's point of view, we have one of our listing agents, John Carr, who will be discussing things from a lister's point of view. And we have Laura Salea. She's in the upper right square on my computer anyway. It's like Hollywood Squares. She is going to be discussing things from a buyer's perspective. So please, once again, if you have any questions, feel free to put them in the question and answer box at the bottom and we'll get those answered during the course of things. So let's get started here. We've got a lot to cover in just a short amount of time. Adam, can you we always hear about loan products, you know, everybody hears conventional, FHA, VA, and even jumbo to a certain extent. Can you just kind of run through and touch on those just a little bit? So when we start talking about other products, everybody knows what we're working from.
Yeah, sure, Brian. Thank you. And thanks for having us on today. We're excited to be here and talk to the audience. So main types of loans, your basic ones are conventional, FHA, VA. Austin's going to talk about another product, USDA, and then non-conforming, which is your jumbo space. So simply going through conventional is kind of a little, usually 3% down to 20% down is where you're going with conventional. And the conforming loan limit, which is the maximum you can borrow on a conventional loan, is $510,400. Those loans have monthly mortgage insurance associated to them if you don't put 20% down, and are usually typically for move-up buyers more than anything else, but a lot of first-time home buyers will use them as well. VA is for military, anybody that's been in active duty or reservists or anything of that nature. It's 100% financing. Great loan product. No limit on how much you can borrow. It just all depends on your entitlement and everything, but there's no maximum VA loan. It used to stop at the conforming limit and doesn't anymore. So you can borrow 100%. It has no monthly mortgage insurance, but does have a funding fee associated to it that's financed. For some military people that have been disabled through military, through being in war, whatever, they have a funding fee waived. So that's a huge plus. FHA, which is typically more of a first-time home buyer product, requires 3.5% down, and the maximum loan amount is $331,760 in Chatham County, and that does vary per county. And the down payment can be a gift from a relative or family member. So those are kind of basics on your VA, FHA conventional. And then if you borrow over 510, it's considered jumbo or non-conforming, and that's not sold in the same markets as your traditional financing. It's more sold in the private market. So,
And it is the conforming and the non-conforming is just basically the price. It's not anything to do with the person's credit or anything like that. It's just the price of the home they purchase,
Strictly the loan amount, not even the price, strictly the amount you want to borrow.
the loan.
So, and it's
Too, like you said, it's because if you're paying down, a significant amount of money, you may fall back into the conforming. Okay.
that's right. So somebody buys $1 million house and puts it down, they're still conforming.
Right.
So,
Austin, I know there's one more that we didn't mention there, and it's not quite as common as the rest of this. And I think Adam mentioned it there a little bit. The USDA loan, which is the U.S. Department of Agriculture, that supports that program. So there again, it's part of the government. Can you talk about USDA for us just a little bit? I think we have a slide we're going to put up as well.
Yeah, so the USDA is kind of one of your off the beaten path products. It's a rural development loan, so it's geographically specific. Pretty much for Savannah, as far as Savannah goes, west of 95 is where you get into USDA. Some small pockets in Chatham County, but mostly your Effingham and Bryan County is where you're going to see all your eligibility. And obviously, the farther you go out, Bullock, you're going to be eligible out there. But it is like the VA loan, 100% financing loan. No down payment is required. The caveat with USDA that's a little bit different than we see from some of our normal loans is that they do have income caps. So for the Savannah area, the income cap for a 1 to 4 person household is going to be $90,000. So, you and your spouse can't make over that amount, and they'll get your tax returns and make sure. Now, I think Metro
Just a little bit. You said 90,000.
90,000. I think it's 90,300 to be exact is where they cap you. Now Atlanta is, I think 95.6 if you're in Metro Atlanta. That's the only part of Georgia where it's a little bit more. And then if you actually have a 5-person household, it goes up to 119,000. But that's a rural development loan, and basically it's just like VA in that they do have a upfront 1%. It's not as much as VA, but they do have I think it's 1.1% rolled into the loan amount. And so USDA is really what you're looking for when you're out in the Effingham and Bryan counties, and you don't want to make a down payment. So we do that product as well.
And just to clarify, because I know I've been through this with some of my clients before, the household limit on income would include anybody, even if they're not responsible for the loan. So if you have a child that works, for instance, that their income.
Yeah, and if they see that on the bank statements, if they see $100 coming in, they're going to ask, hey, what is that? So they're pretty strict and pretty rigid on that. So the best thing for USDA is, 1, to make sure that you're looking in an eligible area, and 2, to get with your lender and make sure you're under that income limit.
And I noticed too that it says on the flyer here that's on the screen, 640 minimum credit score. So that's not a base for all products. That's something specific to USDA loans, correct?
Yeah, that's not even lender to lender based. That is the Department of Agriculture's mandate. So anywhere you go to get a USDA, you've got to have a 640.
Okay. So while we're talking about that, I want to mention to you that next month we are in the process of planning one of our next coming webinars. It's called The Credit Strikes Back, and it's going to be all about preparing your credit and making the right plans for your credit. And I believe that Adam or Austin are going to be joining us on that one as well. There's a lot of great information and tools that they have available in some of our other lenders. So look forward to that. Check our blog at homesofgreatersavannah.com. And we'll be posting that dates for that coming up. Probably be the middle of July. Again, it's called The Credit Strikes Back. We're trying to get a little creative with our names here, so bear with us. Laura, I wanted to ask you, as working with buyers like you do quite often, are there any specific needs or products that you see that come up that maybe most people aren't aware of? As realtors and lenders, we all are, but there's some special circumstances out there. Can you talk a little bit about that?
Absolutely. I have found, especially right now in the seller's market where homes are selling very quickly, a lot of buyers come into it not necessarily prepared at the moment to make an offer, because they still need to list their house and put their house on the market. And in working with Bank South and other lenders, we've been informed about various programs that will help folks in those situations. Basically, in a sense, it's a cross collateralization or a bridge loan that they may be able to use the equity in their home as the down payment for the purchase of the new home without selling their home first.
Well, that's great. So Adam, we're able to use some of that equity, like Laura talks about, and possibly carry 2 mortgages at once, which nobody ever wants to do. So can you kind of walk us through that process with that and explain?
Yeah. So we're to Laura's point, we've been in very interesting times in the last few months, and there's been a lot of change with COVID-19, and a lot of people I think now looking to move maybe weren't looking to move 90 days ago, so they didn't really plan out a strategy of getting their homes on the market first and then buy once they've sold. So been a lot of change. Maybe they need a new office. They just need more space because they were in tight quarters, or great opportunity to upgrade with interest rates as low as they are. So what they can do is they can get what's called a bridge loan and cross collateralize between the home they're going to be selling and the one they're going to be buying, and or depending upon how much equity they have in the home they're selling, they can just simply get a line of credit from that home and use that for the down payment to go ahead and buy the future home that they want. And a lot of people really like it because then it gives them the opportunity to get moved into the new home, settled in, and get the home fixed up to put on the market so that it's in tip-top shape and get a little more premium on the price. And they don't have to move twice. So we've had a couple of clients,
the market's so competitive right now, and homes are selling, in a matter of hours or days. So that would be, you don't want to lose the perfect house for you. So that's a great product.
Yeah. It allows them to, if they've got the equity, to not put the minimum down payment, but to maybe put that 20% down so they don't have mortgage insurance and they get the absolute best interest rate. And then as soon as they sell the departure home, that loan's paid off. So they're in great shape, and they get to take advantage of the super low interest rates right now.
Is there a lot of additional cost associated with doing that as far as origination?
Very little. There's, I'd say about, depending upon the size, because there's some intangible tax on it and so forth. Mm-hmm. Lender standpoint, it's a cost of $750 and an appraisal. Okay.
So that's not bad. So John, your sellers, you work with sellers and you're listing houses, and sometimes you go into a listing appointment and they've got the 1975 mirrored dining room and tile kitchen countertops, and they, you say, look, you can spend a little bit of money and fix up this house and make it more on the return, because everybody wants to move a move-in ready house. But sellers sometimes don't have the cash to do that. Do you ever run into those situations? And can you kind of talk about that?
Yeah, absolutely. Where, if they just put $5 to $10 grand in their house, they get another $20,000 out of it on the market. But when people are trying to buy a house and they're worried about their next home, they need that money for a down payment. They need that money for moving, appliances, and it's tough. People want top dollar for their house, but especially with the whole COVID-19 situations, people don't have top dollar to put into their house to get that out. So that's pretty common.
So, we talk about it as listing, and just to kind of follow up there, how much, we say a house is worth because of location, but how much does that presentation of the house matter when you walk into there as far as terms of days on market and things like that?
It matters a ton. We're starting to see with home prices kind of go up a little bit, and we're entering like a hyper seller's market. Everybody's looking around and going, oh shoot, Billy down the street sold his house in 10 days. I need to put mine on the market. And they're getting top dollar for it. But then the problem is, what people don't understand is, something as simple as like wood floors. Like I think about when I look at a house, I kind of always look at like location and other stuff, but I try to look at a house how my wife would look at a house, because she's the smart one. And she's instantly looking at floors, appliances, countertops, how much work needs to be done, things I don't think about necessarily. So just as simple as like putting $3 or $4 grand and putting different floors in could instantly affect the time in the market. Almost all the buyers I work with, I don't hear anybody request carpet. I'm just being honest. I can't remember the last time someone said that. So that's what I think of all the time of, you put down wood floors in your house, your time on the market will be significantly less. And those are things that if you put that money in, that investment really pays for itself.
Yeah, that's a great point. And before I get to Adam and Austin, because I want them to comment on that a little bit about some product that they have that can help with that. If you refer to our last webinar that we did, if you go to our YouTube channel, Glenn Jones Group, Coldwell Banker Access Realty, or our blog at homesofgreatersavannah.com, we did a terrific webinar a couple weeks ago called Selling Your Home at Seller's Market that discusses a lot of that stuff that John. We had Dean Estridge on there, our managing broker, that reviewed a lot of actual hard data numbers that what a difference in what we're talking about. So Austin and Adam, either one of y'all can jump in here. What happens in that case if a seller needs to get some hands on some cash to sell their house to do, some minor upgrades?
There's two different ways. Like there's a renovation of the home you want to sell, and then there's also doing a renovation loan maybe on the home you want to buy. I'll touch on the renovation loan in terms of for the seller. So, and it circles back kind of that bridge loan aspect or that equity line. It's really simple in the day's environment to go and get an equity line on your current home if you don't just have cash laying around to pull 5 or 10 grand to do some repairs or fix some things up. And even to the point that you can get an equity line based on after improved value. So depending on your equity position, you could get a bid for what you want to do to get it in tip-top shape after your agent's the work that needs to be done, and tap into a line of credit. You need probably 30 days to get that together and put together and closed on it so you have access to it. But that's an easy way to get quick cash to it. And then when you sell the house again, it's paid off.
That way you get rid of that 1970s tile and, the
That's right.
countertop.
That's right. That's right. And we're one of the few banks in town that I know of that'll give you a line of credit on a home that's currently actively listed. So that's a plus too. And I do think, the consumer today walks into a house and they want it all done, like John was saying, and it makes a big difference on value that you get out of the home.
And I know right now y'all are swamped doing refinances because of the interest rates being so low. If a house isn't there some rule with you guys or with all institutions that if a house has been on the market recently that you can't do a refinance? Am I correct in that, or am I?
That's the typical rule of thumb. You would have to remove it and then start the process and do an LOX as to why, like a letter of explanation as to why you're taking it off the market. But you could still do it as long as you remove it. Now, the line of credit I was speaking about on the bank side, you had your home listed for 90 days and you weren't getting activity, and then you listened to the advice the agent gave you on the phone and said, you know what, I need to do these 3 or 4 things. Obviously, I've learned that. We could get you a line of credit in place while the home is still actively listed, and it wouldn't matter on the line of credit side.
Okay. So it's kind of like this thing, you spend a little bit of money to get more money back in return. So Laura, you obviously out showing houses and things like that, and kind of touching off of John. Do you ever take a client to a house and it's the perfect location, and but the house is kind of, it's too much of grandma's house inside still, or it's not that on trend that the buyers are looking for now? Do you ever talk to your clients about a remodel product, a loan product?
Absolutely. And one of the things that I encourage all my clients to do is to, right from the beginning, talk to a lender, get with a lender. That will not only help them be pre-qualified and they'll know what their budget is, but then they can also find out about all these different products that are available in the event that they find the perfect house, but it's just not quite right yet.
Okay. So Austin or Adam, one of y'all can jump in here on the renovation loans. I know that's a product that not everybody offers, but I know you guys do, and a couple other lenders do. And I have some experience with it myself. I did it myself for a home I purchased last year. Can you talk about the advantages of that?
Yeah. So to that point, there's a lot of different types of renovation loans. And like Laura said, that's why it's important to sit down with your lender on the front end and kind of explain what you're wanting to do, because maybe it is the equity line, maybe it's a full renovation, maybe it's getting plans and specs and doing a construction loan on the home you find. So there's a lot of options, but your baseline renovation loan can allow you up to 97% of value. You can go in and say, find a house for $150,000, but it needs $20,000 because it's got that carpet in there, like John. It's got, the kitchen needs to be replaced, like Laura was saying, and you can get a bid from a licensed general contractor, and we will use that bid, submit for the appraisal to get the value based on the home after the work's done. So that $150,000 home with $25,000 worth of work might be worth $180 or $190. And then you can borrow up to that 97% of the acquisition, which is what you paid for the home, and the combination of the amount you spent in renovations. So for simple, if it was bought it for $150, $50 in work, $200 total, you could actually borrow up to that $194,000. And therefore, that's the biggest thing the consumer sees. They go to buy a house, they've got their 5% down, but they know they need a kitchen redone, and the 5% is all their money. So they walk away from it.
Well, and I think one of the advantages of it is, speaking from personal experience, that the renovation loan costs a little bit more. Y'all charge a little bit more because there's more behind the scenes for you guys as far as interest and things like that. But it's still going to be a whole lot cheaper doing that than it is putting it on a credit card or taking the money, borrowing the money as a home equity loan or some other kind of a loan. And it's tax deductible as mortgage interest as well. So
That's correct. That's correct. Unless it's some kind of short-term project where you can get 12 months interest for your carpet, you're going to be able to pay it off. Bar none is the best way to do it because those long-term rates are super low right now.
you're talking about, you stay in a house, even if you stay there 7 or 8 years, you're going to pay that off, and it's part of the house, and that money's not coming from somewhere else, is the way I look at it. So I think it's a great product. There is a little bit of effort getting everything put together, especially if you're on a tight squeeze. So you really want to plan ahead. Like Laura said, that's a great point that she made. Give it that lender from the beginning at that remodel product. So, you want to be lining up contractor and, that sort of thing. So you don't hit any hiccups along the way. Austin, what about construction loans and land lots? I know a lot of times it's not as common sometimes as it used to be, it seems, where people buy a lot and want to build their own home on it. Can you kind of talk about that a little bit?
Yeah. So as far as the one-time close, you can have a lot. Usually, you'll have somebody who wants to buy a lot and sit on the lot and pay the lot off. And then they're going to use that lot as your collateral or your down payment for a building process. So you can have that. Sometimes lots can require a little bit more down, 25 to 40% down. And we can do a lot loan through our bank side, through our commercial side at Bank South. But if you want to do a one-time close, what you can do is, you can have a 10% down payment. You can, save money because you don't have two closings. So if you close on a lot and then close on a house, you'll have to have two separate closings, pay attorney fees twice, pay prepaids twice, that kind of stuff. So if you want to do it all in one, we offer that. And that way you only have to go to the attorney and close all in one. As far as a conventional loan, you can have a construction to permanent loan that will be put into a 30-year mortgage. Just like if you were, buying a house that was already built or already existing. So usually, we do them for people that are looking to move into the house. I don't believe, Adam, we don't have an investment property construction to perm, do we?
No, the construction to perm is for primary and secondary. And so the biggest thing, single close, like Austin was saying, is it will save you a bunch of money if you can go that route. Usually when you identify the property you want, you probably need to engage in an architect and so forth at that point and get your plans and specs for that house. Because when you close, we got to know what you're building so we can do the appraisal to ensure you're going to have enough funds based on the equity to do it. And then during the construction process, you're going to only pay interest on what you've drawn while you're building. So, and it's going to be simple interest. So it's just going to be the interest on the amount that you draw as you take draws. And then as you get closer to completion, within 6 months, we can actually modify that loan term and that rate into a long-term 30-year fixed rate for you and float it down basically. So.
And I know you guys will do, sometimes people find a piece of land they want to buy. I had some clients earlier this year that I helped find a piece. They're not ready to build on it now. So you guys, I know a lot of places don't just finance lots anymore or, land, that sort of thing. I know you guys do. It's 25% down, correct, on those?
Usually on acreage, it's 25% down, yeah.
All right.
That's very typical rule of thumb. But then again, similar to we talked about the bridge loans, if you've got a house and you got equity there, you can kind of cross collateralize it if need be.
And sometimes it's good, if you find a place you might want to be and you're not ready to build a house, buy a lot and then, sit on it. So
take your time.
Make sure things cheap. Also, what about this Georgia Dream program? I'll give you a couple seconds to talk about that. I know you talked about it a little bit before to us. So can you kind of explain what that is?
Yeah. So Georgia Dream is your typical down payment assistance program that the state puts on. It's actually through the Department of Community Affairs. So if you have someone and there are income caps on it, kind of like USDA, where if you make too much, they won't, give you the grant or the second loan on there. But apply for $5,000 with a down payment assistance. If you're a nurse, a firefighter, you can apply for that kind of position. A teacher, I believe, you can apply for their PIN program, which is $7,500. And then they do have a statistically targeted area, which is actually most of Savannah, which will allow for $15,000 down. So what they do is they couple that with an FHA loan usually. So that covers your 3.5% and usually cover most of your closing as well. So the one thing you've got to watch out for those is they do have their own underwriting. So they do, you do have to do a little bit longer of a close, not usually a 30-day close on those. And you have to be wary and mindful of those income caps and make sure that your client make sure that your clients don't make more than, I think it's 56 or somewhere around $60,000, somewhere around there. And it's a little different than USDA. It is just the loan amount, or the person who's on the loan. So that kind of give you a break there, but then obviously it's a little bit lower than USDA as well. So that's your down payment assistance program that you hear about in Georgia, and actually, believe it or not, other states have programs that are similar to those. So I know South Carolina has some sort of down payment assistance program as well that they have through their Department of Community Affairs as well.
That's some great information, and I can't stress enough to all the buyers out there and to us in this today. Like Laura's point, you got to find a lender and a realtor that you trust and you want to work with and have your best interest in heart, and start from the beginning, because there's a lot of these type things out there that you don't know exist that you can help you with. Because there's really, if you have decent credit, there's really no reason why you shouldn't be able to buy a home now. There's so many first-time buyer programs and down payment assistance programs out there. And I say this for all of us: we want to help you get a home. I mean, that's what we all like to do. That's how we all get paid. We'll be perfectly honest with you. We don't get paid if we don't sell houses and get deals done. So, so that's a great tool. I'd encourage you to also refer to our YouTube channel. I mentioned it earlier. It's Glenn Jones Group on YouTube. We have some great prior webinars on there. We did one of our first ones we did was on first-time home buyers, and there's a lot of great information on there. We had a lender on there that discussed a lot of that kind of stuff, so I would refer you to that. So, John, we got a couple minutes here, so we're going to wrap up here in the next 3 or 4 minutes. One thing I wanted to touch on, when you're listing a house and you present those offers to a seller, one of the things we always talk about is the type of financing it is. What scares your sellers when you go to present an offer, besides the price, because they always want more, but what scares your sellers?
The biggest thing that scares them, especially if someone who's maybe sold a house before, is there's sometimes a stigma with like USDA, FHA, VA, just because there's like an extra appraisal process, and they can request repairs. With a conventional, it's just straight up. If the home appraises, for the most part, then you're good to go. With those other type loans, they come in and you have to have outlets up to code. You have everything up to code, and usually you don't run into problems with it, but it is a scarier process because now there's one more person coming in inspecting the house, and one more person with that. Closing times, I think USDA earlier this year, I did a home and we had to wait a little bit longer with closing. It was like 60 days. And even then it felt like it was pushed. Sometimes with VA, depending on the company, they can be a little bit slow, which is why I encourage my VA buyers to go through someone like Bank South or whatever. Sometimes the people that are better provided can be slower and hard to get in touch with. But yeah, those are the ones in my experience that sellers get a little bit wary of, because they're like, hey, look, I know with a conventional, after the home inspection, after the buyer's cool with it, it just is. But with those other ones, there's a whole other loop to jump through.
So Adam, I think sometimes, and you can touch on this and give you, like I said, we're still tight on time. What are some of those myths that need to be debunked? I know sellers get scared about when they see an FHA or VA, it's not going to close, the person's credit's not good, that's why they're in an FHA. VA is going to give us a hard time about closing. Can you just give us kind of a quick rundown of that?
The myth is, I would say that for the most part, it's the lender on the other side of the transaction knows what they're doing. A lot of times when you have mistakes or errors, it's large companies that have bigger turn times on their processes and their flows, and they aren't small and nimble and they don't have good relationships. But VA is a great product. It's one of the best products there is, especially for somebody that's looking for 100% financing. And the loan is really easy on the front end to do, so it should typically always pan out. It
There may
does.
be little repairs that come along with it, but
Yeah,
they almost always close.
Yeah, they typically always close. You can't, like, they'll address rotten windows, or if you don't have a heat source, things of that nature. But if for the most part the home's in pretty good shape, it's going to be okay.
Okay, that's great. Well, I appreciate everybody's time today. Everybody did a lot of great information here. I'm sure we could go on for hours more with a lot of this kind of product. Just reiterating what we talked about, it's very important to work with a lender from the beginning. You know, we get excited, we see a house, we want to go call a realtor and go look at it, but it's really important to know what you can afford to buy. Because you fall in love with the house and you can't get it, that's nothing worse than that, and disappointing yourself and your family. Again, I would love to direct you to our social media and our website. Our website is homesofgreatersavannah.com. Tons of great resources on there. You can read about all of our agents. We have a terrific blog on there that our agents, contribute to on timely topics in the real estate industry. And we have a calendar of community events on there, recipes from our agents and things like that. So I would encourage you to check that out. Our YouTube channel. We have Facebook, Twitter, all that great stuff. So thank you very much, and be on the lookout for our next webinar coming in about 2 weeks. Thanks everyone for participating. Have a good day.